How do you test the financial feasibility of a business idea? Well, to begin with, you need to start with a market analysis, if you will. That is, you need to determine the size of the potential competitive market in which you'll be offering your good or service. If there are tons of customers, then this is generally better than if there are very few customers. Now, if there are very few customers, you certainly need that the competitive landscape be less competitive. That is, you might focus on a niche market where you and maybe only a few other competitors are offering that value proposition. If there is a huge market, there is likely to be numerous competitors. So take this in mind when you start to identify the potential addressable market. That is, identifying those individuals in the market who would be or could be served by your value proposition. Next, make a reasonable estimation of what percentage of the available market you believe that your business is capable of capturing. That is, if there are 100,000 people in the market total, and you believe it is reasonable based upon the competitive landscape that you could validly obtain or acquire 5% of the available market, well, in that situation, you've got 5,000 customers that you believe you are going to be able to acquire during that period. That's the starting point to determine what is the potential for your good or service in the market. That is, what is the total addressable market and percentage of that market that you will be able to serve. Next, begin to project how long it will take you to acquire whatever percentage of that available market, and what is the pace at which you will acquire those individuals. So if it happens early in the game, that is, there's a mass exodus from other competitors or a large onboarding of customers or clients, and you believe that you'll grab that 5% within the first year or two, this should be demonstrated within the projections. And then after that, it will tail off a bit and your customer acquisition will slow. Or will it be a gradual customer acquisition over that period of time? The reason you need to determine this is because this is going to relate closely to the amount of revenue that you're going to be able to generate during each time period. It would allow you to figure out financially whether you're going to generate adequate revenue to cover the costs that you are going to incur at a given period of time, or how long it will be before you become profitable given the amount of costs that you incur early on in starting up and in acquiring those given customers. This is a very difficult thing to project. So you are using your best estimates and your best figures that you have from existing third-party or direct research in the market to understand what amount of value you believe you are going to get from whatever percentage of the market that you acquire immediately, and how that value will grow as you proceed in your business growth. Next, you will project the amount of capital requirements to get the business started and to run the business. Generally, this consists of startup costs, that is, all the costs that you'll have to invest up front to get the business running, and then what fixed costs will you incur, and what variable costs, that is, the costs that escalate as you produce more product or serve more clients. Fixed costs remain the same throughout, where you may have a step up in fixed cost if you move to a more expensive location, a larger warehouse, a nicer office, that type of thing. Generally, the cost is going to remain fixed over the period of, say, that lease, or over a fixed period of time. Variable cost, if you add one more customer or client, then you have a rise in cost based upon the addition of that client. So to the best of your ability, based upon the nature of your business, if you can project the startup cost, the fixed costs that you incur, and the variable costs per client, you will be able to compare this against the revenue that you will generate in total and broken down per client to see what is the difference between the two. Oftentimes, it is common that businesses lose money throughout the early portions of their existence. And oftentimes startup ventures lose money for many years at the expense of growth, because they are putting all revenue generated back into growth methods or growth approaches to obtain or acquire more customers, users, clients, that sort of thing. So when you are financing the venture, you will look for investors who wish to put in their money, and you will run the business and grow the business with their money until some future point at which the business ultimately becomes profitable. Now, the business may be sold to another venture before that happens, and that acquiring venture is the one that sees the growth path to fruition to make the business profitable in the future. In these scenarios, once again, you're going to have to cover those early startup costs and fixed costs that go beyond whatever revenue you generate from customers or clients. So you take those 5-year projections and estimate that you will produce a certain level of revenue throughout. Then you identify the cost, startup costs, fixed and variable, compare those against the two, and for some period of time where there is a deficit, where there is not adequate revenue to meet the cost, you will use, again, funds from investors, funds from lenders. If you borrow money, you have to pay interest on it, so that will be another fixed expense that you incur as part of the borrowing process. But all these taken together, you are in essence doing a complete financial projection, but you're doing it more back of the envelope. You're doing it in a more succinct manner to try to get a feeling of whether undertaking this venture at all is going to be a feasible undertaking, whether it is going to be possible financially for you to carry out this venture and to produce the amount and type of value you wish to produce in undertaking the venture. So in summary, this is how you do an initial financial analysis to determine the feasibility of a business idea.